All right, and welcome back, everyone, to Money Show's Virtual Expo. We are pleased here to have Peter KRAUTH. He's a former portfolio advisor and a 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. He is editor of two newsletters to help investors profit from metal market opportunities, Silver Stock Investor and Gold Resource Investor. In those letters, Mr. KRAUTH writes about what he is buying and selling. He takes no pay from companies for coverage. Peter, such an honor to have you here today. It's all yours, sir.
Thank you, Mark. Pleasure. Pleasure's mine. And thank you to Money Show for hosting this wonderful event. And I'd like to thank everyone who is attending today, this presentation. So I'll get right to it. Today's presentation is how to invest in silver's massive potential. It will be four sort of separate topics. The first part is silver's demand drivers, being essentially inflation and industrial demand. From there, I'll go to what's next for silver, and then silver's massive potential, and ultimately how to invest in silver. So silver demand drivers, one of the biggest drivers right now is inflation. As much as the Fed keeps telling us that what we see of inflation right now is just transitory, that certainly doesn't appear to be the case. In fact, we've seen it across all economic sectors. Yesterday, the June consumer price index came out, and that was 0.9% for the month. That was the largest 1 month change since 2008, so 13-year high. And over the last 12 months, we've seen the consumer price index up by 5.4%. So that's really quite a level for inflation and well beyond the Fed's 2% target. Just a little perspective from someone everybody knows, Warren Buffett, who certainly is well placed to give us his view on inflation, being with Berkshire Hathaway, who's involved in so many sectors across the economy. He recently said, "We are seeing very substantial inflation. It's very interesting. We're raising prices and people are raising prices to us, and yet it's being accepted." So how does this all affect silver? Well, we have ideal conditions for both demand drivers for silver as an inflation hedge and on the industrial demand side. The chart on the left is 5-year forward inflation expectations. So that was kind of meandering sideways for as much as 4 or 5 years and then dropped dramatically when we hit the peak of the pandemic panic in March or so of last year. It recuperated almost immediately, started trending upward very quickly, overtook its previous sort of peak at the beginning of 2020, and then has been soaring higher ever since. In fact, just recently we saw 5-year forward expectations for inflation reach, in fact, a new high, which took out the 2018 level. We look at the consumer price index that as well is accelerating. This is for all urban consumers, excluding food and energy, which tend to be more volatile. If you include them, in fact, these numbers are even higher. So basically what we can see is there was a clear dip that took place early last year because, again, of the pandemic, that quickly recuperated, regained its trend line. And in the last sort of 4 or 5 months, we've seen an acceleration in consumer prices. So what does this do? This actually affects commodities dramatically. The chart on the left is commodities versus inflation expectations, and these are charted together. So interestingly, what we have is inflation expectations tend to lead commodity prices by about 2 or 3 months. And we've seen that track very closely going back the past 5 years or so. So that inflation expectations bottomed, as we saw earlier in the previous chart, and commodities prices bottomed shortly thereafter and have been climbing very, very steadily ever since. If we look at the chart on the right, we have the producer price index. This is prices to producers, all sorts of raw materials, inputs to manufacturing, and so on. And so that was in quite a multi-year sideways range, actually had peaked previously in the right around the financial crisis in 2008, then dropped and went sideways for about 13 years, and then again, early this year, we saw that that clearly broke out. And so we have now producer prices on a very, very sharp climb. We look back about 50 years, commodity prices versus the S&P 500 to get some perspective of the price of commodities versus the overall broader stock market. So this starts in 1971. That ratio actually was very low, was bottoming actually then. We saw another multi-decade low in 2000 when commodities were very, very cheap compared to stocks, and then went through a decade-long rise up until 2008. Again, that's the peak of the great financial crisis. Commodities versus stocks dropped dramatically and had been dropping very much steadily, in fact, until just the start of last year. It certainly appears they have hit a bottom and have started to trend upwards. And so for commodities to regain even just the median of the last 50 years from where they are right now versus the broader stock markets, they would need to be up actually 4 times from current levels. So that's really quite the baked in potential for commodities. And this is a closer, shorter time view on commodities. This is the CRB index, again, a broad index of commodities. We saw that it bottomed in 2000, reached a peak in 2008, and then dropped. And over the last sort of 5 years, it's been going sideways. And we see that commodities have clearly broken out in the early part of this year, reaching a new high that, again, was previously reached in 2018. What's driving all of this? Well, certainly the global green revolution has a lot to do with it. If we just look back very quickly over the previous revolutions, industrial revolution was first, that being with the steam engine and mechanization in the 1700s. The next century brought us mass production and assembly lines. The third industrial revolution was in the 1900s, so last century, and that was all about automation and computing. And so today's fourth industrial revolution is all about networks, interconnectivity, and actually a transition to clean energy. What's different this time, however, in terms of this clean energy and new industrial revolution is that it's a globally coordinated and strategically driven effort that is driven by economy, it's driven by stimulus and all sorts of social factors in terms of cleaner energy to minimize pollution and global warming and so on. And the interesting part is that we know that silver is a big part of a lot of these technologies. So certainly a lot of upside in terms of this major trend. We look quickly at silver supply. We see that it's very seriously challenged. Mine supply peaked in 2015. It's been declining steadily for the last 5 years. It got worse last year with the COVID shutdowns. It's been an industry and worldwide issue. We see that if we look at the world's 10 largest silver producing countries, it's been the case of lower silver production across the board, the largest 3 being Mexico, Peru, and China. In fact, none of the top 10 has managed to escape this downward trend in silver production. An interesting aspect of silver is that less than 30% of silver comes from what we call primary silver mines. In fact, 73% of the silver that's produced that comes from mining is only a byproduct of producing other metals like gold, lead, zinc, and copper. So the quandary that this brings is that silver prices are very much affected by the production of these other metals. If silver prices rise, the miners of gold, copper, lead, and zinc are often not necessarily motivated to produce more silver because it tends to represent just a small portion of their revenues. So because of this, we call much of the silver supply, mining supply, to be inelastic. And right now what we're faced is a low supply, falling supply, growing demand, which is a perfect storm for even higher prices for silver. We look again quickly at silver demand. This is last year's demand levels. And in this case, I exclude ETFs. As much as 54% in this scenario came from industrial demand. So that's everything from solar panels, electric vehicles, and electronics. Those are the main drivers. 22% of silver demand came from physical investment for silver, and then you have silverware, jewelry, and photography making up the balance. But what we've seen is that in the past year, investment demand for silver has actually been exploding. ETFs are a really large part of silver demand. In the past year, in fact, ETFs have accounted for 330 million ounces of silver and over a 1 billion ounce annual supply. That actually represents basically a third of the entire year's supply of silver has gone into silver ETFs. So at the current time, silver ETFs globally hold about 1 billion ounces in silver, which represents an entire year's supply of silver. What has happened with physical demand? It has been crazy. It's actually been pushing up premiums on coins and bars, which today trade at are at triple the normal level of premiums. And this has been driven by different factors, things like Wall Street bets and the silver squeeze movement. And that has actually brought massive attention to the silver market. And interestingly, we now see a new generation that's participating in silver and silver markets. We also see the US Mint, for example, that has come out recently and said that they see a global silver shortage. That's specifically meant to address silver rounds, blanks that they use to make silver coins, but nonetheless, they're certainly dealing with massive shortages as well. Here is a chart that I've created myself. What I've decided to do was combine demand for physical silver together with the demand for ETFs. Now, the larger research groups in this sector decide to completely leave out the demand for silver ETFs on the demand side. They actually list it all separately. I think that it's more interesting and a better picture to include it, because certainly that demand is there and it affects the overall view if you do include it. So whereas if you don't include it, physical investment demand for silver represented about 22% last year. If you include silver ETFs, it doubles it from about 22 to 43%. And that pushes industrial demand overall to about 40%. So as I said, investment demand for physical silver, even as well as ETFs, has been exploding. If you do include demand for silver from silver ETFs, then last year's overall net supply was in a deficit position of 250 million ounces. So that's 25% of the entire year's supply of silver. As I said earlier, silver has many industrial applications. Solar panels represent 100 million ounces per year. So that's 10% of the entire demand for silver every year. The Green Revolution has been pushing that higher. We talked about automobiles. Electric vehicles use twice as much silver as the internal combustion engine technology, that type of vehicle. Last year, silver demand for automobile sector was 60 million ounces, and the Silver Institute expects that to rise to 90 million ounces within just 5 years. Electronics is a very large part of silver demand. Printed and flexible electronics were 48 million ounces last year. And again, the Silver Institute expects that to rise by 2030, so in the next 10 years, by 50% to as much as 74 million ounces per year. And silver is very important in medicine. We've certainly been seeing that increasingly so in the last year with the coronavirus. Silver is crucial to being used for applications like killing bacteria. It limits infections. We now find it embedded in medical equipment. It's in silver we have silver nanoparticles that are in things like cornea replacements and contact lenses. So certainly medicine is a big part of silver consumption. We talked about vehicle demand soaring and EVs using twice as much as internal combustion engine vehicles. And a large part, or perhaps underappreciated part of silver demand is EV infrastructure, so start charging stations. Biden has talked about massively growing the network of EV charging stations, and so that would certainly contribute considerably to silver demand. We talked about electronics and strong growth from that subsector. So electronics overall represent nearly a third of overall global silver demand each year. So that's 329 million ounces last year. Printed and flexible electronics, as I mentioned earlier, are growing dramatically. And this is something that is around all of us. Things like on-off switches, RFID inventory tags. Silver is used in things like smartphones, it's in sensors, laptops, tablets, it's really everywhere. It's all around us without us, in fact, even realizing it. So what's next for silver? Well, if we look on in a comparison of the silver price to the overall money supply, we saw that back in 2000, when silver started its last bull, silver was actually bottomed at that point. It was very cheap versus the money supply, and over the next decade rose dramatically and gained tremendously over versus the money supply. It again bottomed in a clear way we saw last year in March, and so we have a considerable rise since then, and certainly expect for that to continue on over the next several years. One interesting tool to gauge the silver price versus the gold price is the silver to gold to silver ratio. So this is essentially how many silver ounces it takes to buy 1 gold ounce. The ratio was climbing from silver's last peak in 2011 all the way until March of last year. So that meant on a relative basis, silver was getting cheaper versus gold. The ratio peaked in March of last year at an all-time high of 125, meaning it took 125 ounces of silver to buy an ounce of gold, and has been falling dramatically since. So that means silver has been catching up with gold in terms of valuation. Right now, silver, it takes about 68 silver ounces to buy 1 gold ounce. The longer term average is closer to about 55 on the ratio. So if we take a round number of $2,000 gold, that would imply at 55 gold silver ratio, that would imply about $37 silver, which is about 33% above where the silver price is right now, near $26. So what has silver done in previous bull markets? Well, the 1970s bull market was actually quite dramatic. Silver rose from about $1.30 in 1971 to peak around $50 in 1980. So that was nearly a 37 times return, or 3,640% return. Silver had a somewhat of a repeat of that in the early 2000s, from 2001 to 2011, being up nearly 11 times. And silver stocks, of course, tend to leverage silver. So in 2016, in the early part of 2016, if we do a comparison of the silver price using the SIL ETF versus a basket of silver stocks using the SLV ETF, we saw silver rise by 48% in about 6 or 7 months in early 2016. And over that same time frame, and again, this is with a basket of silver stocks, that basket was up 240%. So we saw 5 times leverage over the silver price with the average silver stock. More recently, well, silver stocks have started to outperform gold stocks. If we look from the bottom in March of last year, silver stocks are up about 160%, whereas gold stocks are up still nicely, about 80%. So what we started to see is, as I said, an outperformance of silver stocks versus gold stocks. And we certainly expect that to continue, especially as the gold-silver ratio continues to fall. So silver has massive potential. Silver is entering what I believe is its acceleration phase. If we look at, as I said earlier, previous bull markets, we had a dramatic climb in the 70s. We had somewhat of a repeat of that in the 2000s. And right now we've seen a clear bottom. When silver bottomed in March of 2020 last year, it bottomed at about $12, which was 3 times its 2001 low, around $4. So with that in mind, I certainly feel like we've seen a bottom recently, and we've certainly seen the start of a new rise. Silver is more than double off of last year's lows and certainly looks primed to accelerate. An interesting aspect of silver versus gold in previous bull markets is that silver has always outperformed gold. In the 1970s bull market, on a percentage basis, we see a big difference in silver's peak versus gold's peak. That's all the way over on the left. Then in the 2011 peak for both metals, we saw silver again on a percentage basis easily outperform gold. And right now, gold is about 10% off of its all-time high at around $1,800 versus its all-time high near 2000 of last year. And silver is around $26, which is still at about 50% only of its all-time high near $50. So on that basis, we certainly see lots of potential for silver to outperform gold. The outlook for silver is exceptionally strong. The chart we have here is the CAPEX cycle by silver miners. So that means the spending of silver miners that has been off, in fact, quite low and steady, but low and falling. In fact, in the last couple of years, it's been down nearly 20% year over year recently. So that means that they're actually not spending to either expand or to find more resources on average. And that's actually very bullish for silver companies that have silver, are discovering silver, are advancing silver projects, or are producers, but perhaps smaller producers. And interestingly, February this year, the Silver Institute said that the outlook for the silver price in 2021 remains exceptionally encouraging, with the annual average silver price projected to rise by 46% over last year. So what's been happening with silver miners, in fact, gold and silver miners, is that their free cash flow has been exploding higher. If we look at what's been happening over the last 2 years, they're basically loaded with cash, with higher gold and silver prices, and them having lower debt and having cut costs. We're seeing that cash flow is tremendously higher. And that's certainly very bullish because they're going to need to start deploying that cash to replace depleting reserves. So how do you invest in silver? Certainly there are many options. The most basic would be physical silver, things like coins and bars. One problem with that right now is, as I was saying earlier, premiums are very high. They're triple the normal levels. From there, you have the option of physically backed silver ETFs. My preferred option in that area is the Sprott managed PSLV silver ETF, which has very low premiums, sometimes actually trades at a discount to its net asset value. And then from there, you have baskets of silver miners, silver ETFs, royalty and streaming companies, large silver producers, growing producers, developers, and then ultimately junior explorers. So how do I vet silver investments? Well, my criteria are my main 3 filters. I certainly have more, but these are the main ones that a company needs to get through for me to spend more time on it. The first is management. I look for lots of experience, depth of experience, prior successes as well. If it's an explorer, well, they certainly need to have as well access to a great deal of knowledge and resources to help advance their exploration efforts. Grade higher is always better. If it's a developing silver company or an explorer, I look for close to or better than 50% of the asset being silver on their main project. If it's a producer, I look for revenues or at least 50% of revenues essentially coming from silver production, which is actually not that easy to find. The chart here on the right is the projected revenue mix for some of the largest silver producers. And as you can see, only about half of the top 12 will have 50% or more of the revenue coming from silver. And then thirdly, location. Well, safer is better in my view. I favor North America. So that's Canada, the US, and Mexico. I also like parts of Australia, parts of Europe. As for South America, some parts of that are okay. And much of it, in essence, in my view, is otherwise to be avoided. One big way to approach the whole sector is what I say is to be early and be right. So some crucial factors are to identify the bull market as early as possible. Silver right now is still 50% below its all-time high, so it's certainly a great time to get involved. There's plenty of upside left. I say to hold on through corrections because silver can be volatile. If you know that and you expect it and you're prepared for it, then you will have an easier time dealing with it. And that will certainly help you to maximize profits. And well, silver investments will certainly benefit from a rising tide. So even if some of your silver stocks, silver investments are only average, the fact that the entire market is moving up and moving up strongly will certainly help to lift your silver stocks as well, even if some of those are just average. So the newsletter that I write is Silver Stock Investor. It's a exclusively silver focused newsletter. It's all about what I buy and sell with my money. It's unbiased. I receive no compensation from the companies that I write up. I cover the full spectrum, everything from silver ETFs, large producers, royalty companies, and producers, developers, all the way down to junior silver explorers. And because I cover all of that spectrum, it is aimed at everyone from newer to all the way up to more experienced investors, because I have everything in there from lower to much higher risk stocks. It's published by Resource Maven. We're independent and supported exclusively by subscribers. And as a precious metals expert, I regularly contribute articles to these different websites. So if you want to know more, I encourage you to go to silverstockinvestor.com. Remember, silver has massive potential and we are in a huge silver bull market. And one last point to note, right now we have a special offer. It's 90% off. That's $15 for the first 3 months. If you want to participate, actually, I want to mention that that's Canadian dollars. So for all you US-based viewers, that's closer to maybe $11 US for the first 3 months. Just go to resourcemaven.ca/subscribe. Select the $49 per month option for membership and enter promo code or add promo code SILVER90. And that should bring you to the special offer. So that is it for me. Thank you to everyone for listening and viewing today. And Mark, if there are any questions, I would certainly be, if there's time, I'd certainly be open to that right now.
All right, excellent. Thank you, Peter. We do have a couple of minutes here for some questions. We had one viewer that writes in, they say cyclical declines of 30 to 40% within an intact secular silver bull market are expected. What typically does trigger such a decline? For a patient investor, what major support level for the spot price presents a good juxtaposition of risk to reward?
So, all right. Well, thanks for that question. The first thing I'm going to say is that, there certainly can be multiple things that will trigger that. You could have a sell-off in the market. I would think that fear would be one of the first things, and that can be broad-based. If general stocks sell off, we saw that that's the best example. Most recent example is that last year in March, when the pandemic hit, and we had the peak of the pandemic panic, basically everything sold off: stocks, precious metals. One of the few things that gained was the US dollar, and it was very temporary. You can look at charts. In both cases, the dollar peaked very quickly and then sold off. And then precious metals actually bottomed very quickly and then started to regain very, very, very suddenly. So in terms of some sort of a floor for someone who's patient, right now at $26, I mean, we're in a great spot. I think that there's always a potential for some downside. If you saw silver go down to perhaps maybe $23, $24, I think that would certainly be a great place to accumulate. The problem that I see with that right now, again, is that physical silver, and that's, if we're talking about silver, unless you're looking at stocks, physical silver is very expensive to acquire right now because premiums are so high on coins and bars. So hopefully that answers the question.
All right, excellent. Thank you. Let's see, another question came in there in regards to mining in South America. Are there any countries in South America that they should be avoiding at this time?
So for me, the sort of biggest flags are with Bolivia. From there, right now, at least temporarily, I would say Peru. Um, Chile is kind of, I'm on the fence about right now. It would have to be a really interesting project and have a longer sort of time frame to be able to sit out some volatility. And some parts, at least, of Argentina, I would also avoid. So I would say sort of those are the biggest ones, top of my head, that I would certainly have some concern with.
All right, excellent. And would you recommend sticking with, or which would you recommend, physical, digital, or paper when investing in silver?
Well, in some ways, they all have their place. I'm not sure what what the viewer means by digital, but what I will say is that physical, certainly having at least some physical, I think, is important. If someone has no exposure to silver at all, even paying right now some higher premiums to have at least a very small amount of silver, I'd sort of feel comfortable with. In terms of paper, if to that subscriber, in my view, is at least that might mean something like silver ETFs that are backed by silver. I'm not against that. I don't consider it a substitute for physical silver. I am comfortable, at least as I was saying in the presentation, with the Sprott managed PSLV silver ETF, simply because of the way that it's managed, how and where the silver is held, who's managing it. I'm just overall more comfortable with that product. And digital silver actually brings up an interesting point. Perhaps we're getting a little bit ahead of ourselves, but I certainly feel that with what we've seen with cryptocurrencies, and at least some people hesitating in terms of comfort because they're not necessarily backed with anything tangible, I would certainly see that potentially someday we do see some already. I think we're going to see that evolve more, but that some cryptocurrencies are backed actually by gold or silver. They have a claim on gold or silver that's kept vaulted by multiple parties. So I certainly see a lot of potential on that side. I think that's going to be a big upside, and that could actually be a very large and ready area to accept silver production, where these silver-backed cryptocurrencies would be a ready stream for produced silver to go and be stored and used to back those currencies.
All right, perfect. And just one last one to wrap us up here. They're wondering, is there a settlement period when you basically close out or sell your ETFs or close in funds?
Oh, that's going to be just as no different from any stock. I mean, essentially, you're buying a stock on the market, and whatever the normal delays are right now, if it's a day or a couple of days, that's what you're facing with ETFs. It's essentially the same as a stock.
All right. Well, Peter, thank you so much for joining us today. It's always a pleasure to hear you speak, and we look forward to hearing from you again soon.
It's been a pleasure. Thank you, Mark, and thanks again to everyone who's been spending the time listening.
All right, everyone, thank you as well. Be sure to check out that special offer you'll see on the screen right now. So again, big thank you to Peter, and stick around. We have some more fantastic content along the way, and we have one more day. So we will see you back here shortly. Thanks for being here.